Imagine walking into a boardroom and telling your shareholders that you actively plan to, well, shrink your top-line revenue.
Right, which sounds insane.
It really does. You're basically saying, we're going to walk away from thousands of customers.
Yeah.
We're going to intentionally stop manufacturing some of our highest volume products, and we're going to just actively cede market share to our competitors.
Just hand it over.
Right, just hand it over. And then you look those same shareholders dead in the eye and tell them that this exact strategy, this intentional shrinking, is precisely how you're going to generate record-breaking profit margins.
And deliver market-beating returns.
Exactly. I mean, it sounds entirely counterintuitive. It breaks, basically every rule of modern hyper-growth corporate strategy.
Oh, absolutely. The strategy that demands you capture every single dollar available in your total addressable market.
Right, the whole Silicon Valley mindset. Yeah. But that is the exact playbook of a century-old industrial titan called Illinois Tool Works. Or ITW, as we'll call it.
Yeah. It really completely flips that traditional growth model on its head. I mean, in an era where companies will just, light billions of dollars on fire just to acquire a user, or to capture like a fraction of a % of market share, ITW is operating with this level of surgical discipline that almost feels, antagonistic to modern Wall Street expectations.
Antagonistic's a great word for it.
Yeah, they're proving that you don't need a top-line revenue chart that looks like a hockey stick, right? You don't need that to build an absolute fortress of cash flow.
Well, welcome to the special Talk Tickers edition of the Deep Dive. We are analyzing the Illinois Toolworks Q4 2025 earnings call today.
A really fascinating one.
It is. And our target audience here is you, the retail investor who actually wants to understand the mechanics of the businesses you own rather than just, trading on momentum or flashy headlines.
Right, getting past the noise.
Exactly. We're going to bypass the corporate fluff and get straight into the signal. Because we're looking at a company that is essentially a masterclass in operational discipline.
Mm-hmm.
And this specific earnings report is so dense with structural lessons that, well, we're pulling it apart piece by piece today.
Yeah, we have to.
We're looking at the top line numbers, the underlying strategy, the 2026 guidance, and most importantly, what this actually means for your portfolio.
And, this Q4 2025 report is particularly fascinating because it serves as a bit of a stress test.
A stress test, right.
Yeah, because the current macroeconomic environment is just incredibly mixed right now. I mean, you have localized recessions, you have these massive disruptions in global auto manufacturing.
The auto sector is wild right now.
It is. And then you have significant headwinds in residential construction on top of all that.
Yeah, exactly.
So if a company can expand its profit margins in this specific environment, well, it tells you something really profound about the underlying structural integrity of their business model.
It really does. So let's get right into the raw data, starting with the top line. For the fourth quarter of 2025, ITW reported total revenue growth of 4.1%. And on the bottom line, GAAP earnings per share came in at $2.72, which is a 7% increase year over year.
Not bad at all.
No, not at all. And then we hit the operating metrics. Operating income at $1.1 billion, which is up 5%. The segment margins expanding 120 basis points to a record 27.7%.
And that 27.7% margin figure, I mean, that is the anchor of this entire report.
It's massive.
It really is. But before we get to that profitability engine, we really need to dissect that 4.1% top line growth number.
Yeah, we do.
Because looking at the raw, unadjusted figure in the industrial space, it's incredibly deceptive.
Yeah, this is where we need to separate the signal from the noise for you guys listening. Management reported 4.1% total growth, right?
Right.
But they explicitly highlighted that their organic growth was only 1.3%.
Yeah, quite a drop.
So for a retail investor evaluating the actual health of the company's underlying demand, how do we reconcile that gap? What's going on there?
Well, you have to strip away the optical illusions. I mean, total revenue simply measures the absolute number of dollars that landed in the business account compared to last year.
Right, the raw cash.
Exactly. But ITW is a massive multinational conglomerate. A huge percentage of their daily transactions happen in euros, in yen, in yuan, and British pounds.
Okay, yeah.
And when the quarter ends, they have to consolidate all of those global ledgers and they have to translate them back into US dollars for their SEC filings.
So wait, this is purely a function of the currency markets then?
Precisely. In Q4 of 2025, the US dollar weakened slightly against some of those major foreign currencies.
Oh, I see.
So because of that exchange rate shift, the exact same volume of sales in Europe, let's say, mathematically translates to more US dollars.
Got it.
That foreign currency translation provided a 2.5% artificial lift to their total revenue.
Wow. So it's like an accounting bump.
Yeah. It's a windfall, absolutely, but it has absolutely nothing to do with ITW selling more tools or more fasteners or more automotive parts.
It's like getting a raise at work versus just finding a $20 bill on the sidewalk.
That's a great way to put it.
Right. Like the currency bump is the $20 bill. It's nice to have in your pocket, sure.
Oh, for sure.
But it's macroeconomic weather. You enjoy the sunshine when it's there, but you can't, build your long-term business plan assuming the weather will always be perfect. The 1.3% organic growth is your actual raise from your boss.
Exactly. That is the actual core performance. And on top of that 2.5% currency tailwind, they got another 0.3% bump from a recent acquisition.
Oh, right. Buying revenue.
Yeah, when you buy a company, you suddenly get to add their revenue to your top line, which makes your growth look faster.
Of course.
But when you strip out the currency look and you strip out the acquired revenue, you are left with that organic growth. The organic growth isolates the core legacy business.
It tells you exactly how the products they owned last year performed this year.
Yes, and for Q4, that organic growth was just 1.3%.
Which paints a vastly different picture of the global economy, doesn't it?
Completely different.
I mean, a 4.1% growth rate implies robust, healthy expansion. But a 1.3% organic growth rate tells me the global industrial demand environment is, well, it's barely grinding forward.
It's very sluggish.
Yeah. It's positive, so we aren't in a deep industrial recession. But nobody's popping champagne over a 1.3% expansion in real demand.
No, definitely not. And that is the crucial takeaway from the top line. The underlying demand environment is incredibly sluggish.
Yeah.
And recognizing that sluggishness makes the bottom line numbers look almost physically impossible.
Right.
Because if your actual core sales volume is only growing by a tiny fraction over 1%, how on earth do you grow your earnings per share by 7%?
Well, that's that margin expansion to 27.7%.
Yes, they expanded their margins by 120 basis points. I mean, in an inflationary environment where labor costs are super sticky.
Super sticky, yeah.
And raw materials are totally unpredictable, finding a way to keep an additional 1.2% of every dollar that comes through the door is phenomenal. It demonstrates profound operating leverage.
Okay, I want to focus on another top-line dynamic before we drill down into how they actually achieved that margin expansion.
Yeah.
Because management was very eager to point out their sequential revenue jump.
Oh, yes. The quarter-over-quarter jump.
Right. From Q3 to Q4, revenue jumped 4%. And they noted that historically, their normal seasonal jump for this time of year is only 2%. So why is this specific 4% jump so highly emphasized in their prepared remarks? Why do they care so much about that sequential beat?
Well, in the industrial sector, quarter-over-quarter metrics can often be a lot more illuminating than year-over-year metrics, especially when you are trying to spot inflection points.
Okay, how so?
Industrial conglomerates operate on very predictable seasonal cycles, like construction slows down in the winter months in the Northern Hemisphere.
They can't pour concrete in a blizzard.
Exactly. And automotive manufacturing has specific retooling periods. So ITW knows exactly what a normal Q4 looks like compared to a Q3. It's usually just a 2% step up.
So doubling that historical average implies what? A sudden injection of momentum?
It implies that either end market demand is waking up much faster than anyone anticipated, or ITW is suddenly taking aggressive market share away from competitors.
Or maybe a combination of both.
Exactly. And management noted this strength was broad-based across their divisions, which gives analysts a lot of confidence that 2026 is starting on much firmer footing.
It wasn't just one lucky contract skewing the numbers.
Right. The entire portfolio experienced a stronger than expected seasonal lift.
Okay, so we have the framework here. We have sluggish organic growth of 1.3%, but a surprisingly strong sequential finish to the year, and an absolute explosion in profitability with margins nearing 28%.
Yeah, that's the setup.
So to understand how they engineered this, we have to look under the hood at the operational philosophies that dictate every single decision this company makes.
The fun stuff.
The really fun stuff. Because if you read any analyst report on ITW, you are instantly hit with two acronyms, CBI in PLS.
Customer back innovation and product line simplification.
Right.
These are the twin engines of ITW. And they aren't just corporate slogans, They're incredibly rigid operational frameworks.
Let's start with the growth engine, CBI. The CEO, Chris O'Herlihy, stated that CBI-fueled revenue growth reached 2.4% in 2025. And they're aggressively tracking toward a goal of 3% or more by 2030. They also reported a 9% jump in patent filings in 2025, which is wild because that followed an 18% jump the year prior.
And those patent filings, that's the leading indicator here.
How so?
Well, you don't file patents for generic commoditized products, right? You file patents to protect highly differentiated specialized IP.
Okay, I want to push back on this concept just a bit because customer back innovation sounds like the kind of sterilized jargon a consulting firm charges millions of dollars to invent.
It does sound a bit corporate.
Right. Isn't CBI just a fancy way of saying we ask our customers what they want and then we make it? I mean, how is this a proprietary competitive advantage? Doesn't everyone do that?
It sounds like standard practice, but the vast majority of legacy industrial companies actually do not operate this way.
Really?
Yeah. Most legacy manufacturers operate on what is known as forward innovation, or a technology push model.
Okay, what does that look like?
Their internal R&D departments sit in a vacuum, essentially. They develop a new material or a new mechanical process that they think is technically superior.
Right.
They patent it, they manufacture it, and then they just hand it over to their global sales force with the instruction to go find customers who are willing to pay for this shiny new technology.
They build a better mousetrap and just assume the world will beat a path to their door.
Exactly. And the failure rate on that approach is staggering. I mean, you sink millions of dollars into R&D and capital expenditures to build a product that the market might completely reject.
Because it doesn't solve an actual urgent pain point for them.
Exactly. ITW's customer back innovation completely reverses that flow of capital and risk.
Okay, walk me through the actual mechanics of that reversal. How does a CVI project begin in the real world?
It begins directly on the customer's factory floor.
Literally.
Literally.
Yeah.
ITW embeds their engineers into the operations of their key clients. So let's say they are working with a major automotive manufacturer.
Okay.
The ITW engineer observes the assembly line and notices that a specific robotic arm is slowing down the entire production line.
Why?
Because a standard fastener is difficult to grip and torque correctly for that specific robot. And that tiny bottleneck is costing the auto manufacturer millions of dollars in lost throughput every single month.
Wow. So they have identified a massive, highly quantifiable pain point right there.
Right. So the ITW engineer goes back to the lab and says, look, we aren't trying to invent the fastener of the future here. We are going to invent a highly specific proprietary fastener that solves this exact torque issue for this exact robotic arm.
Oh, wow. And they co-developed the solution with the automaker.
Exactly.
I see the difference now. By the time the product is engineered, the demand is already locked in.
The R&D risk drops to near zero. But more importantly, look at what this does to pricing power.
Oh, I bet.
When ITW delivers that specialized fastener, they aren't competing on price against a dozen commodity screw manufacturers in Asia, right?
It's not a race to the bottom.
Exactly. They're delivering a proprietary patented solution that saves the automaker millions of dollars in assembly time. And because ITW owns the patent on that specific solution, they can command massive premium pricing.
And the automaker happily pays the premium because their overall assembly cost still drops.
Exactly. It's a win-win.
And it creates an incredibly deep moat. The customer is so deeply integrated with ITW's engineering process, meaning the switching costs to go to a competitor later are astronomically high.
Yes.
That explains why those margin numbers are so robust. The 9% jump in patents isn't just about protecting ideas, it's about locking in high-margin revenue streams for the next decade.
Exactly. That's CBI. CBI is how they expand the gross margin on the top end. But to fully understand that 27.7% operating margin, you have to look at how they manage the bottom end of the portfolio. That is where PLS comes in.
Product line simplification. We mentioned this in the intro, the idea of intentionally shrinking the business, which still sounds crazy to me.
It is crazy to most managers, but PLS is rooted in the Pareto principle, the 80-20 rule.
Right.
In almost any business, 80% of your profits come from 20% of your products and customers.
Makes sense.
Conversely, you are dedicating a massive amount of overhead, warehouse space, supply chain logistics, and sales force energy to a long tail of products that barely generate any margin at all.
But the natural instinct of any sales executive is to defend every inch of market share.
Always.
If a product is marginally profitable, even if it's just a 1% margin, the traditional mindset is to keep selling it because, well, it covers fixed costs and adds to the top line.
Right. And ITW management ruthlessly rejects that mindset.
They just got it.
They look at that long tail of low-margin commoditized products, and they systematically amputate them from the portfolio. They shut down the production lines. They walk away from the revenue entirely.
I can imagine that causes massive internal friction.
Oh, definitely.
I mean, you have regional sales managers whose bonuses are tied to revenue targets.
Yeah.
And corporate is telling them to just stop selling 30% of their catalog.
Yeah, it's a huge cultural shift.
Furthermore, what does this do to channel relationships?
Yeah.
Like if I am a massive distributor, let's say a Home Depot or a Grainger, I want a supplier who can provide everything I need.
Right, a one-stop shop.
Exactly. If ITW stops manufacturing the basic commodity hardware and only sells the premium patented items, doesn't the distributor just drop ITW entirely in favor of a competitor who has a full catalog?
That is the primary risk of a PLS strategy. And honestly, it's why most companies lack the stomach to execute it. But ITW leverages the strength of their CBI products to maintain that channel leverage.
How so?
The premium patented products, the 20% that drive the real value, are so highly demanded by the end user that the distributor has no choice but to carry ITW.
I see.
Like if you're a professional contractor, you specifically demand the premium ITW pass load nail gun or the Tapcon concrete anchor because nothing else works as well.
You won't settle for the generic brand.
Right. The distributor has to stock it. So ITW essentially calls the distributor's bluff. They strip out the low margin junk and force the channel to focus exclusively on the high margin winners.
Wow. And the margin expansion covers the lost volume.
More than covers it. When you eliminate that low margin tail, you don't just lose revenue. You eliminate warehouse costs, you reduce inventory carrying costs, you simplify your supply chain, and you dramatically reduce the administrative burden on your back office.
The business just becomes radically lighter.
Radically lighter and more efficient. The revenue goes down, but the absolute dollar profit goes up.
Okay, this theoretical framework becomes incredibly real when we look at the segment by segment performance in this Q4 report. Because when we break down the winners and losers across their 7 divisions, we see CBI and PLS operating in real time.
We really do.
Let's start with automotive OEM. Revenue was up 6% and organic growth was up 2%. But the headline here was an absolute massive surprise out of China.
Huge surprise. The automotive segment grew 5% in Q4 in China and an astonishing 12% for the full year 2025 in the Chinese market.
This data point requires serious context for you listening, because if you read the global financial press right now, the automotive market in China is described as a graveyard for legacy Western companies.
It's brutal over there.
It is. You have massive established European and American automakers bleeding market share, slashing prices, and taking massive write-downs on their Chinese operations. The domestic Chinese brands are just eating them alive in a brutal price war.
Yeah, the local competition is fierce.
So how on earth is ITW, a legacy American supplier, posting 12% growth in a market where everyone else is in retreat?
Yeah.
What's the secret?
It comes entirely down to where they aimed their customer-back innovation engine. Several years ago, ITW realized that the Chinese market was rapidly pivoting toward electric vehicles at a pace that Western automakers were struggling to match.
Right.
The CEO explicitly highlighted on the call that China still represents roughly 65% of all worldwide EV builds.
But it's not just the volume of EVs, right? It's who is building them.
Right. And here is the critical data point that management cited. Chinese domestic original equipment manufacturers, the local domestic brands, now control over 70% of that EV market in China.
Okay, so if ITW had maintained their historical alliances and tied their fate to traditional Western automakers trying to sell combustion engine cars, or even Western EVs in China,
then ITW's revenue would be cratering right alongside them.
Exactly. But they didn't do that.
No, they didn't. They took their CBI engineers, bypassed the struggling legacy Western brands and went directly to the dominant Chinese domestic EV makers.
Right.
They embedded with the local champions who are actively taking over the market.
So they didn't try to dictate the market, they respected the local dynamic and aligned with the winners.
And because Chinese EV manufacturers operate on incredibly compressed product development cycles,
Like how compressed?
like launching new vehicles in 18 months compared to the 3 or 4 year cycles of Western legacy brands.
Wow, that's fast.
Right. So they desperately need agile suppliers. ITW's localized R&D allowed them to co-develop new EV-specific components at the exact speed the Chinese OEMs demanded.
That's incredible.
They are innovating solutions for battery casings, thermal management systems, and lightweight interior fasteners. They are capturing premium margins in a market defined by brutal price cuts at the consumer level.
Simply because their components solve complex manufacturing bottlenecks for those dominant domestic brands.
Exactly.
That is a phenomenal pivot. It shows a total lack of corporate ego. They didn't cling to their legacy relationships. They just followed the volume and the innovation.
Yep.
Okay, let's shift to the next segment, test and measurement and electronics. Revenue up 6%, organic growth up 2%. The narrative here centered heavily on the semiconductor industry.
Yes, the semi-related businesses were up mid-single digits in the quarter.
I have to say, I am always highly skeptical when industrial companies start talking about semiconductor rebounds.
Oh, totally understandable.
The semi-industry is notoriously prone to the bullwhip effect. You get a tiny bump in end market demand, the manufacturers panic and double their orders, the suppliers triple their capacity, and suddenly you have a massive supply glut and the whole cycle crashes again.
It's boom and bust.
Exactly. Even ITW's CEO acknowledged they saw a CapEx freeze related to China shipments in the middle of the year, then an uptick in Q2 down in Q3. It's wildly volatile.
It is.
So why should investors believe this Q4 rebound is the start of a sustained cycle rather than just another head fake?
It's a very valid skepticism, and management addressed it by pointing to leading operational indicators rather than just the raw revenue bump.
Okay, what kind of indicators?
They're seeing sustained improvements in actual order backlogs and, more importantly, in FAB utilization rates.
Oh, break down FAB utilization for the listener, just so we're all on the same page.
Sure. FABs are the semiconductor fabrication plants. They're the multi-billion-dollar factories that actually print the microchips. Utilization rate is simply the percentage of that factory's maximum capacity that is actively running. When the semi-cycle crashes, utilization might drop to, say, 60% or 70%. The factories are just sitting idle.
And when they sit idle, they obviously don't need to buy testing equipment or replacement components from ITW.
Right. But when demand returns, driven by AI data centers, edge computing, or automotive silicon, those FABs start ramping utilization back up into the 80% and 90% range.
They're running hot.
They are running hotter, they are running longer shifts, and the equipment is naturally taking more wear and tear. That requires immediate capital expenditure on the testing and measurement equipment that ITW provides.
So the utilization rate is the precursor to the purchase order.
Exactly. And look, semi-related revenue is only about 15% of this specific test and measurement segment, so it's a relatively small piece of the overall pie. But as the CFO, Michael Larson, pointed out, it is a highly accretive piece of the pie. When this specific cycle picks up, it historically comes with above-average growth rates and significantly above-average profitability compared to the rest of the portfolio.
Got it. So they weather the down cycle without sacrificing their structural margins, so as the volume naturally returns, the profit leverage will be outsized.
Exactly.
Okay, let's look at the polymers and fluid segment. Organic growth was up 5%. This segment is fascinating to me because it takes the highly abstract corporate concepts we've been discussing and grounds them in consumer reality.
Oh, this is where we really see the diversity of the portfolio. The CFO specifically highlighted the automotive aftermarket growing 5%.
Right, and he cited a very specific recognizable product, like a highly successful new product launch for Rain-X wiper blades.
Yeah. Think about a wiper blade for a second. It is the ultimate commoditized product, right? You can buy a generic wiper blade for a few dollars. It is a race to the bottom on price. But ITW applies the exact same customer back innovation philosophy to consumer retail as they do to robotics on a factory floor.
Wow.
They engineer a premium blade with proprietary water-repelling technology. They patent it, package it under a trusted brand name like Rain-X, and suddenly they are commanding a massive price premium at the auto parts store.
They take a low-margin commodity category and just inject high-margin IP right into it.
Exactly. And in that same polymers and fluids segment, you have their reagents business, which is highly specialized fluids focused on the biopharma industry.
Right.
That business soared over 20% organically.
Which is wild. I mean, you have windshield wiper blades on one side of the ledger and highly sensitive biochemical fluids on the other.
It's quite a mix.
But the connective tissue is the operating philosophy. Whether it's Rain-X or biopharma reagents, they are aggressively pursuing the highest margin, most differentiated niche within that specific market.
That's the playbook.
Which brings us, finally, to the construction segment. This is arguably the most important data set in the entire earnings call because it perfectly illustrates the ruthless efficiency we talked about earlier.
The top-line numbers for construction were brutal. Organic growth was down 4%.
Yeah, and regionally, it looked even worse. North America was down 4%, with the critical residential renovation sector down 5%. Europe was down 4%.
Tough environment.
This is exactly what happens when interest rates stay elevated for an extended period. Mortgage rates cripple the housing market, homeowners stop pulling AGLOCs to renovate their kitchens, and commercial construction grinds to a halt. The macro environment is universally hostile.
And normally, a 4% contraction in revenue in an industrial segment usually triggers massive profit warnings, layoffs, and margin compression.
Because companies slash prices to maintain factory throughput.
Right.
But look at the bottom line for ITW's construction division. Despite revenue shrinking by 4%, operating margins for this segment went UP by 100 basis points to hit 29%.
29% operating margins in a contracting construction market is almost unheard of.
I need you to deeply analyze this dynamic for us. Because if fewer people are buying nail guns, fewer contractors are buying concrete anchors, and overall revenue is dropping, how does the percentage of profit they keep actually expand to nearly 30%? This is the PLS strategy in its purest form, right?
It is the absolute textbook execution of PLS combined with what management broadly categorizes as enterprise initiatives.
Okay.
In a booming housing market, when money is cheap, ITW's construction division might tolerate a little bit of margin dilution just to capture massive volume.
Sure, grab market share while times are good.
But the moment the macro environment turns and that volume evaporates, they activate the PLS protocols.
They stop defending the low margin volume.
Exactly. They look at the localized markets, let's say a specific region in Europe where construction is depressed and cheap imported fasteners are flooding the market.
Okay.
Instead of fighting a price war to maintain their 4% market share of commodity fasteners in that region, they simply exit the product category.
Wow.
They just accept the revenue contraction.
And by exiting the low-margin category, the remaining revenue mix is heavily concentrated in their premium CBI-protected products.
Precisely. They are making vastly more money on significantly fewer sales. Management explicitly noted that these internal enterprise initiatives, which are fundamentally driven by this 80-20 PLS philosophy, added 140 basis points to the company's margins overall.
That's incredible.
They offset the massive macro headwinds purely through self-help.
That is the hallmark of a truly resilient business.
Yeah.
They aren't victims of the macroeconomic weather. When the storm hits, they batten down the hatches, throw the low-margin cargo overboard, and sail through with record profitability.
Very well said.
And this incredibly defensive, highly optimized operational posture sets the stage perfectly for what management expects in 2026. Let's transition to their forward guidance.
Always the most anticipated part.
We always want to know how the management team views the immediate future, and keeping with their conservative nature, the 2026 forecast is very disciplined.
It is. They are projecting total revenue growth of 2% to 4%, with organic growth in the range of 1% to 3%.
Which is basically identical to the sluggish environment we just saw in Q4.
Right. And management was very clear on the call. They are building this guidance based on the current levels of demand, adjusted only for typical historical seasonality.
Okay.
They are not baking in a sudden miraculous pivot by the Federal Reserve. They are not baking in an overnight recovery in the European industrial base. And they are not baking in a sudden boom in Chinese domestic consumption.
No rose-colored glasses here.
None at all. They are projecting based entirely on the reality on the ground today.
I deeply respect that. Too many management teams build their guidance on highly optimistic macroeconomic assumptions to appease Wall Street, and then they spend the next 3 quarters walking those expectations back.
Exactly.
ITW is setting a highly achievable bar. Now, for earnings per share, they provided a midpoint guidance of $11.20. That represents a 7% growth rate.
And once again, we see the structural reality of the business. profits growing more than twice as fast as organic revenue.
Because they expect margins to expand another roughly 100 basis points, targeting a range between 26.5% and 27.5% for the full year.
Right.
But embedded in this guidance conversation was a metric that absolutely leaped off the transcript for me. It's a metric that fundamentally alters how you should value this company's future earnings power.
Oh, I know what you're going to say.
The CFO stated that they expect, quote, incremental margins in the mid to high 40s.
Yeah. If a listener takes only one financial concept away from this entire analysis today, it should be the implications of that specific statement.
It's massive.
Incremental margins in the mid to high 40s is a staggering figure for a legacy industrial manufacturer.
We need to unpack this carefully because it gets to the very core of operating leverage. An investor might look at their overall margin of 27.7% and think, okay, they keep roughly 28 cents on every dollar. But incremental margin measures something entirely different. Explain the mechanics of incremental margin for us.
So overall margin looks at the entire pool of revenue, right? But incremental margin isolates only the new revenue.
Sure.
It asks the question, for every single new additional dollar of sales you generate this year above what you generated last year, how much of that specific new dollar drops straight to the bottom line as operating profit?
So if ITW manages to grow their top line by an extra $100 million next year.
With an incremental margin of, let's say, 45%, it means $45 million of that new revenue is pure operating profit.
Wow.
Almost half of every new dollar coming in the door flows directly to the bottom line.
That seems impossibly high. Historically, ITW's incremental margins have hovered in the 35% to 40% range, which is already exceptional for the industrial sector.
Very high, yes.
Even the analysts on the earnings call were highly skeptical of this new guidance. Jamie Cook from Truist Securities specifically challenged the management team, essentially asking how a company with an overall margin of 27% can realistically expect a 45% margin on new volume.
It was a great question from the analyst, honestly, and the answer highlights the compounding power of years of structural discipline.
What did the CEO say?
He explained that this mid to high 40s projection isn't a one-time accounting trick. It is the mathematical inevitability of the KLS strategy we've been discussing. Over the last decade, ITW has ruthlessly pruned their portfolio and eliminated inefficiencies. They have consolidated factories, streamlined supply chains, and optimized headcount.
They have driven their fixed costs down to the absolute bare minimum required to run the enterprise.
Exactly. The baseline structural cost of the business is incredibly lean. And those fixed costs, the rent on the factories, the executive salaries, the core IT infrastructure, are already fully covered by the baseline legacy revenue.
So when the macro economy finally improves and new volume starts flowing into those optimized factories, they don't have to build a new factory.
No.
They don't have to hire an army of new middle managers.
The overhead is already absorbed.
Yeah.
Therefore, the variable profit on that next unit sold is massive. The only new costs are the raw materials and the direct labor to produce that specific unit.
That makes total sense.
Furthermore, as the CFO pointed out, the new volume driving this growth isn't coming from low-margin commodity screws. It's coming from those highly engineered, patent-protected CBI products, which inherently carry a higher gross margin to begin with.
So you combine a deeply compressed fixed cost base with a product mix that is skewing heavily toward premium pricing, and boom, you get an incremental margin of 45%.
Which means this company is essentially a coiled spring right now.
A coiled spring, I love that.
Yeah, I mean, if they are generating record profits right now while the global industrial economy is merely grinding along at 1.3% growth, what happens when interest rates eventually drop and residential construction surges 10%?
Right.
What happens when European manufacturing awakens?
The moment the macro winds shift from a headwind to a tailwind and organic growth accelerates to 4% or 5%, the sheer volume of absolute dollar profit dropping to the bottom line will be explosive.
That is the bull case for ITW in a nutshell. You are buying a spring-loaded profit engine.
And that leads perfectly into our next vital topic, capital allocation. What is this company doing with the mountain of cash this highly optimized engine is throwing off?
A very good question.
Management noted that their free cash flow conversion is expected to be greater than 100%.
That is a critical metric for quality-focused investors. It means their actual cash flow generated from operations is exceeding their accounting net income.
Okay.
They aren't just generating paper profits, they are highly cash generative in the real world.
And they have a very clear shareholder-friendly plan for that cash. They announced a plan to buy back approximately $1.5 billion in shares in 2026.
Share buybacks, when executed at reasonable valuations, are one of the most tax-efficient ways to return value to shareholders. By actively repurchasing and retiring their own stock, ITW is reducing the total number of outstanding shares in the market.
It's the classic pie analogy. The actual size of the company's total earnings might stay exactly the same, but because there are fewer slices of the pie, your your earnings per share automatically gets bigger.
The CFO quantified this directly, actually. He noted that the $1.5 billion buyback program naturally juices their earnings per share by about 20 cents.
Nice.
Which translates to roughly 2% EPS growth right there.
So when management guides for 7% total EPS growth in 2026, we know that 2% of that is structurally guaranteed simply through the financial engineering of the share count reduction.
Yep.
The core business only needs to generate 5% growth to hit the target.
It creates a tremendous margin of safety for the investor.
We also have to highlight the dividend, because this is where the historical context is truly staggering. ITW just increased their dividend for the 62nd consecutive year.
62 years of uninterrupted dividend growth. That puts them in an incredibly elite tier of publicly traded companies, the so-called dividend kings.
Think about what the world looked like 62 years ago. The streak started in 1964.
Wow.
Since they began raising this dividend, this company has navigated the escalation of the Vietnam War, the oil shocks, and brutal stagflation of the 1970s, interest rates hitting nearly 20% in the early 80s, the Black Monday crash of 1987, the dot-com bubble bursting, the 2008 Great Financial Crisis, and a global pandemic that literally shut down the world economy.
It's unbelievable.
And through every single one of those existential macroeconomic crises, ITW didn't just maintain their dividend. They generated enough cash to increase it.
That historical track record is the ultimate validation of the PLS and CBI philosophies.
It really is.
When you don't chase unprofitable market share and you fiercely protect your margins, your cash flow becomes virtually bulletproof regardless of the macroeconomic weather.
It is the definition of a sleep well at night investment. But looking at all this cash generation naturally raises a strategic question. And it was a question raised by the analysts on the call.
Oh, about M&A.
Right. They're buying back stock and they are paying a growing dividend, but management was conspicuously silent on mergers and acquisitions in their prepared remarks. With a balance sheet this strong, why aren't they going out and aggressively buying growth?
It's not that M&A is off the table, it's that management is ruthlessly disciplined regarding valuation. The CEO clarified during the Q&A that they are actively hunting for high-quality acquisitions that fit their decentralized business model, and that can extend their long-term growth runways.
But they clearly aren't finding anything they like right now.
Well, the CFO, Michael Larson, was incredibly blunt about the current environment. He said, "It's not necessarily an easy time to be a disciplined acquirer." The subtext there is that private market valuations and the expectations of sellers are currently detached from reality.
We are seeing that across the market. Sellers still want the premium multiples they could command in the zero interest rate environment of 2021.
Exactly.
And buyers like ITW, who operate in the reality of a 5% risk-free rate, simply refuse to pay those multiples.
ITW will absolutely not do a deal if it dilutes their near 30% operating margins or fails to generate a premium return on invested capital. They refuse to buy a mediocre company simply to artificially inflate their top-line revenue growth for a few quarters.
They'd just rather return the cash to shareholders.
Right.
Now, they did point out that they aren't entirely sitting on their hands. They referenced the MTS acquisition from a few years ago as a massive success, where they successfully integrated a large target and drove margins up. And they also noted they recently completed a small bolt-on acquisition in the semiconductor manufacturing space.
And a bolt-on acquisition perfectly fits their strategy. They aren't buying a massive, complex conglomerate that requires years of painful integration.
Right. No mega mergers.
They are finding a highly specialized niche company, a missing puzzle piece, and snapping it directly into an existing, well-run ITW division to strengthen a specific product line.
It proves they're actively deploying capital for growth, but they're using a sniper rifle, not a shotgun.
Yes.
They are clipping coupons and waiting for the right valuations.
It is the ultimate luxury of a high-margin business. They don't need to acquire growth to survive, so they can afford to be extraordinarily patient.
Which brings us to the culmination of this analysis. We've unpacked the stagnant top line and the miraculous margin expansion. We've dissected the mechanics of customer-back innovation and product line simplification.
Covered a lot.
We've analyzed the coiled spring of their incremental margins and their disciplined capital allocation. It is time for the bottom line.
And looking at this data, the signal is overwhelmingly clear.
We are taking a definitive position. The signals emerging from this Q4 2025 earnings call are highly bullish for the patient long-term retail investor.
I completely agree. The foundational thesis here is structural durability. ITW is delivering a masterclass in margin preservation and expansion.
You really are.
To achieve near 28% operating margins when European industrial production is weak, when North American residential renovation is contracting, and when global supply chains are still normalizing is a monumental feat of management.
They're controlling the controllables.
Exactly. They are generating record profitability purely through self-help. They aren't relying on a booming economy to bail them out of bad operational habits.
Right.
And because their incremental margins are now structurally locked in the mid to high 40s, the upside potential is massive.
Huge.
The moment the macroeconomic environment stabilizes and begins to expand, when the housing cycle eventually turns and European demand recovers, this incredibly lean, optimized engine will convert almost half of every new revenue dollar into pure profit.
The earnings growth will massively outpace the revenue growth.
Absolutely.
So let's translate this into actionable advice for your portfolio. If you currently hold shares of ITW, the verdict is simple. Hold the line.
There is absolutely no fundamental reason to sell this stock.
You are literally getting paid to wait for the macroeconomic cycle to turn. You have a 62-year dividend growth streak yielding reliable cash, and management is deploying $1.5 billion to shrink the share count and increase your ownership stake.
Yeah.
The downside is deeply protected by that cash flow generation.
But what if you are on the outside looking in? If you are a prospective investor evaluating ITW right now, you need to look past the superficial metrics.
Do not let the 1% to 3% organic revenue guidance bore you away from the stock.
Right. You are not buying a hyper-growth tech company that relies on endless market expansion. You are buying a highly optimized, risk-averse compounding machine.
Yeah.
Because ITW is ultimately an industrial conglomerate, its stock price will occasionally take a hit when broader macroeconomic fears flare up.
Oh, inevitably.
If the market panics over a slightly weak manufacturing index reading or a scary headline about global construction, use that short-term volatility as a potential entry point. You are buying into one of the most disciplined management teams in the world at a localized discount.
It is a profound story of prioritizing the quality of revenue over the pure quantity of revenue.
It is the essence of long-term value creation.
We are going to wrap up this deep dive, but as always, we want to leave you with one final provocative thread to pull on your own. Throughout this analysis, we praised ITW's incredible agility in China.
We did.
They grew their automotive OEM segment by 12% in a brutal market by pivoting away from legacy Western automakers and aggressively co-developing EV components with the dominant Chinese domestic brands.
It was a brilliant, highly pragmatic, strategic maneuver that saved that division's growth rate this year.
But I want you to consider the long-term geopolitical and structural risks of that exact strategy. Right now, ITW is winning by using their customer-backed innovation to solve problems for Chinese OEMs. But Chinese domestic manufacturers, whether in automotive, solar, or electronics, are historically notorious for their drive toward total vertical integration. They want to own and control every single layer of their supply chain.
They want domestic self-sufficiency.
Precisely. So the question you need to mull over is this. Will ITW's patents in their CVI relationships provide a deep enough moat to maintain their premium supplier status in China over the next decade?
That's the million-dollar question.
Or, as those Chinese domestic EV champions achieve massive global scale and begin aggressively hunting for cost reductions, will they simply insource those components?
Yeah, well, they just cut them out.
Could a premium American supplier like ITW eventually find themselves reverse engineered, substituted, or priced out of what is currently their fastest growing regional segment?
It's the localized vulnerability in a globally diversified portfolio. As the Chinese EV market goes, so goes a significant chunk of ITW's future automotive growth story. It is a critical dynamic to monitor.
Will the IP moat hold against the insourcing tide? Something for you to deeply consider as you evaluate the long-term risks. Well, we took the Talk Tickers format and expanded it into an uncompromising, in-depth exploration of corporate mechanics today, and we hope this deep dive gave you the high-resolution signal you need to make informed decisions. Keep looking past the headlines, stay curious about the mechanics of the businesses you own, and keep digging into the data. We will catch you on the next deep dive.